Hey guys, this is Miggs from Market Open, and the topic we're going to cover today is how to read candlestick charts. Now, before we get into it, the candlestick charts, I want to talk to you guys about some of the other type of charts that there are. Most likely you've probably seen them all over television, on the computer, and things because they're a little bit more simpler. The other different types of charts are line charts, bar charts, point and figure charts, candlestick charts. There are other types of charts out there, but this is probably some of the more popular ones. And saying popular with some of these, you'll see what I mean. It's kind of stretching it. If you use like Yahoo Finance, you're probably used to seeing this line chart. Now, with line charts, they're actually the most basic type of charts because it represents only the closing prices over a set period of time. So with this chart itself being on a daily chart, the line is formed by connecting the closing prices for each period. So while this type of chart doesn't really provide much insight into the intraday price movement, so you don't know how high or low the price went during the day, because it kind of cancels out some of the noise for investors. That's why it's kind of popular with investors. These charts also make it a lot easier to spot trends, and a lot of the noise is kind of booted out of the chart, so you don't get distracted when you're trying to figure out a specific trend. Now, bar charts. Bar charts actually expand upon the line chart a little bit by adding the highs and lows and the close, or the daily price range, what it's called, into the mix. So this chart is made up of a series of vertical lines that represent the price range for a given period within a horizontal dash on each side. The opening price is the horizontal dash on the left. So let's see here. So left, and then the closing price obviously is on the right. So if the opening price is lower than the closing price, the line is often shaded black to represent a rising in the period. The opposite is true for a falling period, which is represented by a red shade. So all these, that means that it went up, started here, went up, closed here, it gapped up the next day, started here, went up, and then the next day was a red day. This is a point and figure chart. What I mentioned earlier, some of these are a little bit less popular than others, but it's been around for quite a while. So point and figure charts are not very well used by a lot of day traders or your average investors, but they do have a long history of dating back to the first technical traders. The chart reflects price movement without volume or concern. Without volume and without much concern for the time frame. So it's kind of trying to cancel out some of the noise or insignificant price movement, as I like to call it, which is AKA noise. These charts are trying to eliminate the skewing the effects time has on chart analysis. So point and figure charts are characterized by a series of X's and O's, as you can tell. Oh, let me go back. There we go. As X's and O's, so it basically just looks like a massive game of tic-tac-toe. Another key point to remember is that the point and figure charts have reversal criteria. It must be set by the technical analysis, or analyst. So not all charts are exactly read the same. So what I mean by that is, although it's usually set to 3, the reversal criteria represents how much the price has to move away from the higher or low in the price to create a new trend. Or in other words, how much the price has to move in order for a column of X's to become a column of O's, or vice versa. So as you can see on here, there is 4 red, and then it changes, and then there's O's, and then X's, and then O's, which means it's a complete reversal and it's changing in direction. Point and figure charts are characterized by the series of X's and O's. There are also numbers and letters in the charts that represent months and give investors a rough idea of the dates. So the key word being a rough idea of the dates, because it doesn't really have exact dates on it to kind of cancel out some of the noise. Each box on the chart represents a price scale, which adjusts depending on the price of the stock. So the higher the price stock's price, the more each box represents. So on most charts, each one of these boxes represents about $1. But it looks like on here, this one is probably over a longer period of time and represents about $10 per each box. So now the topic of the day, so the candlestick charts. So candlestick charts originated in Japan over 300 years ago, but have become very, very popular among traders and investors. Like a bar chart, so it's basically a more advanced bar chart. Candlestick charts have a thin vertical line showing the price range for a given period that's shaded different colors based on whether the stock ended up going higher or lower. So the difference is a wider bar in the rectangle that represents the difference between the opening and closing price. So if it's red, it's obviously headed down. If it's green or white, in this instance, it's headed up. Falling periods will typically have a red or black candlestick body, while rising periods will have a white or clear candlestick body. Days where the open and closing prices are the same will not have any wide body or rectangle at all. So they're referring to something that is called the doji, which we'll talk about here in this next couple slides. So now the candlesticks have parts. So if it's a green candlestick, the opening price, depending on the time frame, it starts at the bottom. So if it's a green candle, you start here and it closes here. So also these wicks right here are called shadows. It represents the highs and the lows during that time period. So let's just say that this is a 1 minute candle. It means that it opened here, it dipped here, it came back up as high as here, but it closed during that 1 minute here. Now, if it's a red candlestick, it's the opposite. So opening prices here, it went down as low as here, and it closed during that time period here. So it provides you with all the information that you need to know within that time frame. Now, these are some of the most popular candlestick patterns, and trust me when I say that there's a lot of candlestick patterns out there. That this is definitely some of the more popular ones that you might want to memorize right off the bat. If I were you, I'd probably just screenshot some of these or look them up on either Investopedia or something like that, and just memorize as many as you can, because you can recognize them throughout the day and be able to make better judgments or better calls on entries and exits on certain patterns. So I'll start off here with the doji. So what it was saying is that it's minimal body, so the open and closed price are basically in the same spot. It's a fight between the bears and the bulls, people that are trying to go long and short, which means that it went all the way up to here, it went all the way down here, but it was being sold off and it was being bought up, and they were basically at a stalemate, and the price basically closed at the same. Now, Dragonfly Doji is a very bullish candle, which means that it opened and closed at the top. It dipped, but it got bought all the way back up. Now, Gravestone Doji is the complete opposite. So now it opened at the bottom, it went all the way up, but it got sold off and it closed near the bottom. It's a very bearish candle. Now, an engulfing candle, it can either be a bullish engulfing candle or a bearish engulfing candle. So if it was a bearish engulfing candle, this would be a green candle, and then this would be a very large red candle, which means that it completely engulfs the previous candle, making it a very bearish pattern. So, but if it was the other way around, this would be a red candle, this would be a green candle, which means that the buyers are taking over the price during that one time frame, which means that the stock is most likely headed back up. Hanging Man and Hammer are relatively the same. It just means that the price action was near the top. If you notice, the only difference between these two is just the length that the price hit lows. So, which means that it opened up here, it hit all the way down here, but it got bought up and closed here. Same thing with the hammer. The only difference is this one's red, or black, and then this one's green or white. But either way, it mostly represents a candle that is being bought up, and the price action is near the top. Now, the opposite way, inverted hammer, obviously the price movement is, or the open and close is both near the bottom, and it's being sold off. Same thing whether the candle is green or black or red, whichever way. But it's just saying that the candle itself is being ruled by sellers. Now, these are some examples of a swing trade that I took recently that give you prime example of those hammer candles or dojis. So I noticed that AT&T was had several red days, and they're a pretty well-known company. So I knew that there was going to be some buyers involved as soon as it sort of formed a reversal, some sort of reversal pattern. So my entry for this, I just followed the stock until it threw up some sort of sign saying, hey, this would be a good reversal point, or there's a lot of buyers coming into the stock. So this is a daily chart, which means this one candle represents a day. So I followed it all the way up to here, and I noticed that it threw up this doji candle. Now, my entry was the high of that candle, my stop at the low, and I rode it all the way up to, for, let's see, 1, 2, 3, 4, 5. Rode it up for about 5 days. I sold half around here, and now it's throwing up an inverted hammer, meaning that, like I said earlier, the candle, the day was being ruled by sellers. So now I still have a quarter of my position left, but tomorrow, if it breaks the bottom of this candle, I'm most likely going to sell the rest of it. I'm still at a profit. Alright, so now time frames. Give you a little bit of info on the time frame. So what I was talking about earlier is it really all depends on the time frame. So you can have candlesticks on a 1-minute chart, 5-minute chart, 2-minute chart, 3-minute chart, daily, weekly, it doesn't really matter. So what I mean by that is that each candle represents 1 minute. So here. So the beginning of the day today, it opened up here, closed here, but it went as high as this. Now these represent a 1-minute chart. So if I was to take these 5 candles, this price action is the same as if I was to switch this over to a 5-minute chart. So now all 5 of those candles are inside of here. So the difference in between the 1-minute candle and the 5-minute candles is that the 5-minute candle kind of blocks out a little bit more of the noise to be able to trade a little bit better and to be able to see patterns a little bit clearer. So just for example, here's a little bit of a flag right there. So this is going to be 15 candles. So you'll see the price relatively get smaller and smaller and smaller, and then just explode to the upside. So now let me switch it back over to the 1 minute. So now, see, it's easier to see on the 5-minute because when you have all of these 15 candles that you have to pay attention to, it's a lot easier just to look at 3 and see the price kind of whittle down a little bit and then just explode to the upside. Now, you can also look at candlesticks on a daily chart, which means that each one of these candles represents a day, and just by looking at this chart, you can see some of the patterns I was talking about earlier. So here's something a little bit kind of represents like a hammer. Here's some dojis. See, it's throwing up a couple of dojis, and what did it do? It just started heading to the upside. Here's a hammer. Here's another doji. Let's see here. Yeah, so if you pay attention to these charts, you'll be able to call out a lot of these patterns. Also, there is, if you want to go back even further, there's also a weekly chart. So each one of these candles represents a week. So if you're trying to look back years and years and years, instead of looking at a daily, you can look at charts such as a weekly. Okay, guys, well, hopefully this helped you guys kind of learn on how to read candlesticks. Don't forget to subscribe to the channel and like. If you have any questions, make sure to put them down in the comments, and I'll get to them and answer any questions you guys may have. All right, bye.